Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Hyatts stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 15 billion market cap. They're trading at $149 a share and they have 101 million shares outstanding. Hyatt manages and franchises luxury and business hotels, resorts, and vacation properties. It has more than 1,350 hotels across 69 countries. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really low free cash flow in 2021, still recovering from COVID, only 200 million. It went up 200% and nearly tripled to 600 million in the trailing 12 months. Really nice growth. Their margins are improving slightly from 7% to 9%. Free cash flow margin is free cash flow over revenue. It's the percent of your revenue you convert to free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. Negative in 2021, up to almost 700 million in the trailing 12 months. And their margins look real good at 10%. They converted 10% of their revenue into net income. Revenue is a sales for the company, and that more than doubled from 3 billion to 6.7 billion. A really nice pop in 2022, it nearly doubled, then grew a little into 2023, even less into the trailing 12 months. Their revenue per share is $66. That's revenue over shares outstanding. Each share price is $149, so that means their price of sales is a little more than a 2. Price of sales is stock price over sales per share. And they pay a really low dividend, 0.4%. It only costs them $60 million in dividend payments, which they can easily afford with 600 million of free cash flow. They probably could even raise it a little bit. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 101 million shares. And we get a calculated stock price of 151. They're trading at 149, so they're trading at a 1% discount. It's a small buy according to the model. My valuation usually doesn't come this close to the actual stock price, but in this case it came extremely close, only $2 off. There are 12 companies in the same industry as Hyatt, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 200 million in capex, a lot lower than Marriott. They're also 1/4 of the size of Marriott in terms of market cap. Debt to equity ratio is 0.9, which is the best in this list, tied for Ator. They pay a small dividend, 0.4%. They generate 600 million of free cash flow, which is a little more than the average. They rank third in market cap, pretty far behind Marriott and Hilton. They have a really good price to book, trading at 4 times book value, trading at 22 times earnings. That's better than the top 2 companies. Their price to free cash flow is also better than the top 2 companies. Same thing with the price of sales. They generate 6.7 billion of revenue, higher than the median average, and they're still growing. Their 5-year annual revenue growth rate is 8%. The Chinese company H-World is number 1 at 15%, then Greentree 12%. If you put $10,000 into this company 10 years ago, you'd have $26,000 today. That's a 10% annual return, which is a good return. But Marriott and Hilton have done much better in the past 10 years than Hyatt. Let's discover their first quarter financials. RevPAR is one of the most common terms for hotels and motels. It's revenue per available room. And that increased 5.5% from the first quarter of 2023. So just about at inflation. So not too spectacular. It would be nice to see double digits here. At the all-inclusive resorts, that did increase double digits to 11%. They also increased their rooms. That means they built more hotels or added rooms at their current hotels, but most likely a combination of both. That went up 5.5%. They spent nearly 400 million on the buyback of stocks. They repurchased 2.5 million shares. They're projecting net income for 2024 to top out at 1.2 billion. But as low as 1.135 billion. Their numbers are down from last year. In the first quarter of 2024, adjusted EBITDA $250 million. Last year was nearly $270 million, down 6%. The only category it's up is management and franchising, because they charge a fee for managing the hotels, and they also charge franchising fees, royalties, and upfront fees. That's $200 million. Last year, $184 million. But they're down in every other category. In their management and franchising segment, the improvement was greater travel to China, which benefited markets such as Japan, Thailand, and South Korea. Leisure demand was strong in Mexico and the Caribbean for hotels and all-inclusive resorts. European all-inclusive properties had impressive RevPAR. In the US, RevPAR up 2%, not that impressive. In the first quarter, they had 12 new hotels, 2,400 rooms. Notable hotels included Thompson Houston, Secrets Tides Punta Cana. I went to Punta Cana a few years ago for a wedding. That's the DR, Dominican Republic. They also opened 5 properties in China, a Hyatt Regency in Nairobi, marking the first hotel in Kenya. The projection for 2024 is net rooms growth of 5.5% to 6%. Free cash flow projection is $600 million. That would be ideal if they hit the higher end of the target. They need to break through $600 million. Total revenue $1.7 billion, up a little from last year. Total expenses $1.7 billion. That's also up from last year. Their net income is a lot higher than last year. It's $500 million. Last year, $58 million. But that could be deceiving. It's mainly from the gain of $400 million on the sale of real estate. That's not good net income. Good net income is higher revenue, lower expenses. You can't grow your business by selling it. So you should really strip that out. So their net income should be about $122 million. EPS $5, up from 55 cents. And they're buying back stock. They had $106 million last year, and now they have $103 million. If all the convertible securities converted to equity, they'd have nearly $106 million. RevPAR in the Americas, excluding the US, that includes Canada, that's their highest, 200, up 12% from last year. APAC, excluding China, went up 21%. Their lowest RevPAR is China, $88, but that grew 11.5%. US was pretty much flat. Occupancy is similar to other companies, 67%. That's down 1%. Their best country is APAC, 70%. That's up 7% from last year. There's a lot of travel to Asia, excluding China. In the all-inclusive resorts, occupancy is north of 80%. And look how expensive it is. The RevPAR is $352. Europe is a lot lower, $132. But Europe went up 24%. In the Americas, excluding US, that went up 10%. Their most premium hotel is Park Hyatt, $292 a night. That went up 15% from last year. Their most expensive all-inclusive is Secrets, $373. That's revenue per available room. But if you take revenue across all the rooms, which includes vacancies, but if you strip out vacancies, it actually costs $468 per night. People aren't paying $373, they're paying $468. The reason it's lower in available rooms is because this number includes vacancies. They manage 620 hotels, 190,000 rooms. They franchised more, 688, but there's a lot less rooms, 119,000. They don't own that many, only 33 properties for 13,000 rooms. So their total portfolio is 1,300 hotels, 320,000 rooms. Hyatt Regency has the most rooms, nearly 100,000. The next biggest is Hyatt Place, 62,000. Adjusted EBITDA is a better indicator than net income, because remember, net income for the first quarter is inflated by $400 million from the sale of properties. So even though their net income went up 9x, adjusted EBITDA went down. Their free cash flow forecast is between $575 million and $625 million. This is the forecast for all of 2024. They plan to spend $170 million in CapEx. This is to build new hotels, new properties, or to upgrade their current ones. Let's take a look at the company on Simply Wall Street. Its last price, $148, $15 billion market cap, down 1% in the past week, up 34% in the past year. They operate through a few segments. One of them is owned and leased hotels. Another is America's management and franchising. Then they have Asia Pacific Management and Franchising, Europe, Africa, Middle East Management and Franchising, and Apple Leisure Group segments. The company manages, franchises, licenses, owns, and leases a portfolio of properties consisting of full-service hotels and resorts, select service hotels, and other properties, including timeshare, fractional, residential, vacation, and condos. They have many brands under their umbrella: Park Hyatt, Grand Hyatt, Hyatt Regency, Hyatt House, Hyatt Studios, Thompson Hotels, Dream Hotels, Breathless Resorts and Spas, Dreams Resorts and Spas, Hyatt Vivid Hotel and Resorts, and several other ones. They offer short-term vacation rentals, homes and hideaways by World of Hyatt. They serve corporations, national, state, and regional associations, specialty market accounts, including social, government, military, educational, religious, and fraternal organizations, travel agency and luxury organizations, and a group of individual consumers. They also operate World of Hyatt loyalty program, which rewards points that can be redeemed for hotel nights and other rewards. Founded in 1957, headquartered in Chicago, Illinois. Here's the stock price since 2009. That was its lowest point at 29. And then it kind of went up and down, till it peaked at 86 in 2020. Then they had that COVID dip to below 50, but then the big run up, breaking through 160 just 1 month ago. It's come down to the 140s range, although I think there's more downside than upside with this stock. In the long term, it should be okay, but I think it'll come down a bit over the next year or two. Simply Wall Street's valuation is 221. They say they're 33% undervalued. 20 analysts priced this stock at 162. Their revenue forecast for 2024 is $6.9 billion, 2025 $7.2 billion, 2026 $7.7 billion. Free cash flow forecast for this year is $630 million, next year $760 million, after that $909 million. So they're projecting a lot of growth with this company. 3 analysts projected at over $900 million. Revenue in 2013 was $2.5 billion. It was pretty much flat for 6 years, then under $500 million in 2021. Now it's at the highest point ever, $6.6 billion. Debt in 2013, $1.3 billion. It peaked in 2021 at almost $4 billion. It's down a little bit to $3 billion. And their equity is a little higher than their debt. Marriott and Hilton have negative equity, which means their liabilities are higher than their assets. This company's positive, but it used to be much more positive in 2013. It was $4.7 billion. It's come down to $3.7 billion. And this green line is their cash. They do keep a bit of cash on their balance sheet, about $800 million. That should be enough to pay the interest on their debt. Their next dividend will be paid out on June 10th. The ex-dividend date is May 28th. So you want to own the stock before May 28th to get that dividend. Their dividend peaked at 1.5% in February 2020. It's come down a lot because stock prices come up a lot. The forecast is 0.5% by 2026. The CEO's salary was $1.2 million in 2017, down to $300,000 in 2020, up to $1.4 million in 2023. Total compensation, $21 million, tenure as CEO, 18 years. In the past year, mostly insider selling. There is one buy, but mostly sales. About 90,000 insider shares have been sold in the past year. And half the companies owned by institutions, 31% by the general public, 12% by insiders, and 8% by private companies. Penny Pritzker's father founded this company. She's the biggest shareholder at 6.5%. The next biggest shareholder is a New York City asset manager, Barron, 5.3%. BlackRock, Vanguard, more Pritzkers. Robin Hood owns 1.8%. I'm just kidding, that says Robin Road. Alliance Bernstein, Citadel, Bain Capital, the CEO. And their employee count went from 45,000 in 2013 up to 51,000. The ticker trades on the New York Stock Exchange and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.